Listen, most people think the only way to avoid taxes in retirement is to just stop making money. Well, they're wrong. There is a legal backdoor, a specific set of rules the wealthy use to keep 100% of their investment gains, while the rest of us just hand over 20% or more to the IRS. Welcome to The Explainer. Today, I'm showing you the Stealth Wealth Roadmap. We're going to look at how you can pull six figures out of your portfolio every single year without triggering a single dollar in federal income tax. If you have a brokerage account, an IRA, or an HSA, this is absolutely the most important 10 minutes of your financial life. I want to pose this question directly to you right off the bat. Must you stop making money to avoid taxes in retirement? Absolutely not. It is a complete myth that you have to be broke to be tax-free. By the time we finish this explainer, you're going to see exactly how pulling six figures from your portfolio completely tax-free is entirely possible. It just takes a very specific strategy. Okay, let's dive into this. First, we really need to define what we're actually talking about here. Stealth wealth is not about hiding your money illegally. No way. It's the practice of deliberately keeping your income, your assets, and your lifestyle low profile while focusing completely on long-term financial independence. It's a quiet, hyper-efficient strategy. Instead of signaling your status through visible spending, which, let's be honest, just creates lifestyle creep and drains your accounts, you're prioritizing freedom, privacy, and protecting your wealth from the IRS. So here is the map we are about to navigate together. Number 1, the 0% sweet spot. 2, the triple tax-free healthcare fortress. 3, the Roth Conversion Ladder. And 4, stealth wealth asset location. Let's get right to it. Number 1, the 0% sweet spot. Most people just assume that when they sell a winning stock, they automatically owe a 15% tax. But listen to this. If your taxable income is kept low, roughly below $94,000 for a married couple, that rate isn't 15%. It is exactly zero. Under the 2026 rules, when you combine that with standard deductions, a couple 65 or older can actually realize roughly $146,400 in long-term gains completely federally tax-free. This means you can sell your winning broad market ETFs, which are essentially just large, diversified baskets of stocks, take the profit, and pay absolutely nothing. Imagine taking a massive tax bill and just shredding it into zero. This is a brilliant strategy called tax gain harvesting. You intentionally sell your winning assets in your taxable brokerage account to take the profit, and then you immediately buy them right back. So what did you just do? You just reset your cost basis to that new higher amount for free. The IRS can never touch those previous gains, even if you get richer later on and move into a much higher tax bracket. But you definitely have to follow the rules of tax gain harvesting. You realize those gains purposefully in your low-income years to reset your cost basis. But remember, 0% doesn't mean consequence-free. You have to intentionally size your gains to avoid triggering state taxes or accidentally bumping up your Medicare premiums. Now, the 0% bracket is great for your stocks, but there's one account that's even more powerful because it handles the one expense that bankrupts most retirees: healthcare. Number 2, the triple tax-free healthcare fortress. The Health Savings Account, or HSA, is literally the most underrated account in existence. According to the Employee Benefit Research Institute, a staggering 85% of HSA account holders are using it completely wrong. They're just keeping it in cash to pay for immediate band-aids and copays. But it's actually the only account in the U.S. tax code that is triple tax-free. Your contributions are tax-deductible going in, the investments grow tax-deferred, and the withdrawals are 100% tax-free if you use them for medical expenses. Plus, there are zero income limits to qualify. It essentially acts as a stealth IRA. But here is the real pro move, what we call the stealth reimbursement hack. Step 1, you pay for your medical costs out of pocket right now, and you leave your HSA funds invested so they can compound over time. Step 2, you save that medical receipt digitally. And step 3, you reimburse yourself 20 years later. Seriously, the IRS has absolutely no time limit on when you reimburse yourself for a qualified medical expense, so you can let that money grow tax-free for decades and then hand in 20 years worth of saved receipts to pull out a massive chunk of tax-free cash. We're talking about a completely tax-free slush fund you can use for a boat, a vacation, or a house, all hidden behind decades-old medical receipts. Number 3, the Roth Conversion Ladder. Okay, but what if your money is trapped in a traditional 401k? That money is tax-deferred, meaning your withdrawals are going to be heavily taxed as ordinary income. We've talked about this retirement tax bomb in a previous explainer, but the real solution is figuring out how you get that money out without getting completely destroyed by taxes or hit with that nasty 10% early withdrawal penalty. Here's how it works. In year 1, you systematically convert small amounts of your pre-tax 401k into a Roth IRA during a low-income year. Yes, you pay a tiny bit of income tax on that conversion now. Then you just wait out the IRS-mandated 5-year period. In year 5 and beyond, you can withdraw that converted principal completely penalty-free and tax-free. And this brilliantly illustrates the concept of the ultimate bridge to tax-free wealth. By doing this every single year, you're building a rolling ladder. You're paying a tiny, highly controlled bit of tax today to ensure you pay zero tax for the rest of your life. It effectively builds a bridge right over that 10% early withdrawal penalty. Number 4, stealth wealth asset location. To truly build this roadmap, you have to look at your entire portfolio. Everyone talks about asset allocation, your mix of stocks and bonds. But the truly wealthy, they master asset location, meaning which specific account each investment actually lives in. Putting a tax-heavy asset, like a bond or a real estate REIT that kicks off high dividends, into a standard taxable brokerage account is a total tax disaster. You're basically asking for a tax bill every single year, even if you never sell a thing. Stealth wealth means hiding those tax-heavy assets in your traditional IRA, where they are shielded. Meanwhile, you place your tax-light assets, like those broad market ETFs, in your taxable brokerage. And then you put your absolute highest growth assets right into your Roth, where all that future growth is going to be tax-free forever. When you look at a model like Vanguard's approach to asset location, it becomes so clear. You'll notice how the bonds are deliberately concentrated over in the 401k, while the equities are sitting comfortably in the brokerage account. Think about that. You have the exact same overall mix of stocks and bonds and the exact same market risk, but simply by changing the addresses of your investments, you drastically reduce your tax drag. So, what is this actually worth to you? Well, according to analysis by Goldman Sachs, optimizing your asset location adds roughly 0.4% a year in after-tax value. To put that into perspective, for a standard retiree, one simple swap could easily save you $5,000 a year in hidden taxes you probably didn't even know you were paying. And on a larger $5 million portfolio, that equals $20,000 every single year. It is literally free money just for being organized. I want you to really think about this quote for a second. The system isn't rigged. It just has a manual that most people never read. Minimizing your taxes isn't about finding shady, illegal loopholes. It is simply about understanding the rules of the game that the IRS has already laid out and then deliberately using them to your advantage. Do not let the IRS be your biggest beneficiary. Take the time to apply that 0% capital gain sweet spot, utilize your HSA as a stealth IRA, build yourself a Roth Conversion Ladder, and optimize your asset location. Keep an eye out for our explainer on the best ETFs for 2026 coming up next to help you actually build this out. Until then, I want to leave you with this one question. Are you going to keep tipping the IRS with your hard-earned retirement, or are you finally ready to read the manual and build your tax-free fortress?